It governs. What does it govern? The people. Now, this is a very key, I don't know how much economics everyone's had, but economics is made much more complicated and difficult in college and high school and classes than it needs to be. Think about this. What comes first? What has to exist first in order for the other to exist? Does government have to come first and then the people form around it? Or does the people have to exist first in order for a government to form? The people, right. So that's a very important, I know it sounds like, well, duh, it's people, but think in terms of the solution. Where does government get its tax revenue? The people. That's the only thing it can tax, right? So if you're saying, well, government is the solution, that's putting the cart before the horse. There is nothing that government can do. What you're saying is, let's go to the government for help. You're merely pointing at the people behind the government, which is yourselves, and all the 300 million people in the United States. So what we have now, people say, let's go ahead and have government become more invasive. Government is the solution. The problem is with government growing, what kind of effect is that going to have on your private sector economy? Government's growing, you get to pay more and more, what's going to happen to the private sector? It's going to get smaller and smaller, thus a crowding out effect. Now, here is GDP growth. Any of you see a trend? Because if you do, you've really got great vision, because I can't see a trend. This is all, GDP growth is very volatile, right? So what I like to do is scale it, or roll it out, average it out over several years. Ignore the red line for now, we'll just look at the blue line. The blue line is your rolling 20-year average GDP growth rate, or what I like to call generational gross domestic product. And the R means adjusted for inflation, real, so you don't have to worry about inflation in this case. And what this chart basically shows you is that in the olden days, 40s to the 60s, our average economic growth rate was 4.25% for that 20-year period. So if you take the 20 years, they all average up to that one point. And these 20 years and these 20 years, so that's kind of how that chart works. But you see a very disturbing trend. Our generational rolling average GDP is going down. And by a lot, we used to grow at 4.25%. Now we're at like 2.5%. Does anyone know the power of compounding? Finance majors should know the power of compounding, right? Okay. Without going into a boring mathematical exercise, if we had maintained our growth rate of 4.25%, your standard income per capita, or the standard average income that you would make in the country, would not be roughly $44,000 it is today. It'd be more along the lines of $100,000, which would make our financial problems disappear rather quickly. So you don't really see it here, but we've lost a lot of potential economic growth and income and productivity over the past 50, 60 years. So very disturbing trend there, but again, and the red line is total government spending as a percentage of GDP on the left axis. This includes state and federal. So back in the olden days, it was about 20%. Now, it's actually even higher because this only goes to about 2009. It's definitely about 40, I think 42%. But you see the negative correlation. As government grows, the private sector or economic growth shrinks. Now, the problem with this is the only thing that can solve these problems is being marginalized, shrunk, or otherwise killed, and that is the individual or the private sector. And it's caused by ignorance of people who think that government is the mighty savior of all of our problems, when the only entity or the only group of people that can get us out of this problem is what? Ourselves, right? The government can come along and maybe tax us as we go along. But it's not going to be, well, the government just is going to bail us out and everything's going to be puppies and unicorns thereafter. Another aspect that you guys are going to face, no 401k for you. Do you guys even know who this is? Soup nuts? Okay, good, because I didn't know if you would find it funny or not if I looked very old. So thank you. So you see why that's funny. When you guys graduate, you're going to have to plan for retirement, and what they have are these things called 401ks or IRAs. There are many other programs out there that the government has instituted to give you a financial incentive to go and save for retirement. And that financial incentive is usually a tax break of some kind, so you get to write it off on your taxes, or you don't have to pay capital gains if it's a Roth version. Neither here nor there, the government came up with this idea, hey, let's give you guys an incentive back in 1978. Now, since that time, what was it, 40 years almost? Yeah, 40, no, 35 or something like that. But many years ago, and over that period of time, trillions of dollars have been flooding the stock market, mutual fund market, in the form of people's 401k and IRA contributions. Now, what kind of effect will that have on prices? You flood a market with $1 trillion, what's going to happen to the prices? They're going to go up, right. The problem is, do you really think, and this is like your parents, my generation, when people go and they invest, even automatically, you can have it deducted from your paycheck, like automatic deduction into your 401k account. Are they looking at the underlying stocks and the investments that compile their 401k and IRA? No, they're not even they don't care about earnings, they don't care about dividends. It's like, here you go, yeah, fine. So what's ended up happening is there's been a disconnect between why people should invest, which is the profit that the underlying stock or corporation makes, and its stock price. And you see that with our super happy fun bubble times. You're familiar with bubbles, right? Not the bubbly type, I'm talking the economic type of bubbles. Right? I think you may remember the dot-com bubble. You guys are like 10 maybe? 11? Do you guys remember? 1999, 2000, how old were you guys back then? 5? 6. You're 6? Okay. Wow. All right. Remember Napster? Was that, were you guys like downloading music? Okay, that's this time. All right, there we go. I got it. Music, don't care. To help with PE ratios, we don't care. That's that time back in the olden days. And what ended up happening, everyone invested in .com simply because there was a .com. None of those companies made money. It's just that it was cool. People just threw their money mindlessly at it. You guys know the housing bubble more recently. You're aware of that, right? Okay, so people are throwing money into the housing market. We have an education bubble, which you'll see later. And then what we're talking about today, right now, is the retirement bubble. And this is measured with what's called the S&P 500 PE ratio. In short, 500, the top 500 stocks in the United States. And what we have is a PE ratio. And this is very important because this will help you in your finances in your future. So this can carry forward in other types of financial and investment type aspects of your life. The PE ratio means price to earnings. You take the price of a stock and you divide it by earnings. And what that does is it tells you how expensive or cheap a stock is. Historically speaking, the PE ratio of the average stock going back in time has been 15. Obviously, this ratio changes in the market as prices go up and down. But what you see here, starting in the early 80s, because of the 401k plans and the advent of mutual funds, people throw the money into the market, driving prices higher than earnings. Okay, so earnings are staying down low, prices are going up, so this ratio goes up. Now you see, at the peak of the dot-com bubble, we were paying $45 in stock price for $1 in earnings, roughly 3 times the historical value. Now what this translates into is Modern Warfare 3. Any guys, gals? No one ever played? Okay, Modern Warfare 3. Would you pay $180 for Modern Warfare 3? No, but that's exactly what people were doing. You should pay $15 in stock price to be entitled to $1 in earnings, but they're paying $45. Right? Now, the stock market crashed, then the housing bubble came, so the market recovered, but then the market crashed again as the housing market crashed, and then it came right back up with very minimal economic growth. Now you would think with 2 stock market crashes, this ratio would go down below its average. However, even after the dot-com crash and the housing crash, at that point, we were fairly valued, accurately valued. This was not a steal, this was not a bargain, this was like a Big Mac meal going for $4. Or Modern Warfare 3 going for $60. Or, I'm trying to think of something. I can't believe you're the only guy that plays video games. That's It's like a gallon of gas going for $3.80 today, okay? Is that making your own gallon? But immediately people started investing. So you see that there's money keeping this ratio higher, and this is primarily because of trillions of dollars flooding retirement markets. Okay? Another way to look at it is the dividend yield. Same 500 top stocks in the United States. But what we do is we focus, instead of earnings, we focus on dividends. Because a corporation will make a profit, right? Do you get to keep all of the profits, though? Do they pay all the profits out to their shareholders?
No.
No, they only pay a dividend. Sometimes they will retain the earnings to reinvest back into the corporation. So what really drives a stock from a shareholder standpoint is dividends. And this is kind of the reverse. It's the percent rate of return you can expect in the form of dividends. Historically, stocks paid about a 5% rate of return in dividends, kind of like an interest rate. Now, because prices are so high, you're only getting a 2% rate of return. Does that even beat out inflation? No. So the problem you guys face is that you're buying into a bubble.
Do you think, going back to that last graph, do you think, like if I'm investing in a company that's doing well, I never want to get paid a dividend. I would rather have them.
But this is a very fundamental theoretical question. What is the only form? The only thing that gives a stock value is the dividends it pays. Because when you sell the stock, everyone thinks, you know the difference between a capital gain and just a dividend check? A dividend is what the corporation pays you every quarter or whatever for having ownership. It's your share of the profits. Whereas when you sell your stock, someone pays you $100 when you bought it for $50, so you had a $50 profit. That's a capital gain, but you're no longer entitled to the share of profits, right? So that people are focusing on capital gains. Talk to your parents and say, well, how's your mutual fund doing? They say, good, prices are up. Price is not what the prices are. It's whether the dividends are going up. Because when you sell that stock, what are you selling? So I sell you my share of Disney, okay? I give you my stock, you give me $50. Now what do you get? Why does that stock have value?
Because I can sell it later.
No. Well, in following that thing, well, you can sell it later. Well, why would that person want to buy it?
Future dividends.
Because the dividends, future dividends. In other words, I'm not selling you stock for the sake of having a share of stock. I'm selling you rights to future dividends. And you could sell it to you, and you could sell it to him, and you could sell it, everyone could sell it many times over. The only reason that stock has value is dividends. Up until the point in time the company is bought out by another firm or it goes bankrupt. The end of the corporation comes. In which case you get zero or you get a capital gain from the acquiring company. So I know I don't want to worry you too much with it, but that's why you really want to focus on dividends more than anything else. But the larger point, this is like buying it's a 60% overvaluation. That's like buying, I don't know. It's like buying, paying $7 for gas, I guess would be an equivalent. So you can kind of see how if you're buying into the market today, the average stock, you're equivalently paying $7 a gallon in gas. It's not a deal. It's not a steal. Now, unfortunately, and you're going to see this chart a lot here, because our general overall economic growth is waning, we're not going to have the economy to produce the profits that are needed. However, corporations' profits are growing, but where are they growing? Why are they growing? Where's most of the corporate investment from American corporations going today?
Emerging markets.
They're getting the heck out of the United States, and they're going to Asia, they're going to South America, Mexico, where there is actual economic growth and a potential for having like expanded markets. Coke goes over slow, all the Philip Morris. Cigarette companies love going overseas because they don't have to deal with the regulations here. They just, here, have cigarettes, go kill yourself. Okay, bye. All right. Now, the question for you guys is, given our government's dire finances, it wouldn't dare confiscate your precious little 401ks or IRAs, would it? They wouldn't do that. Governments never do that, unless you're Bolivia or Argentina. This has happened before. Okay? And not only